We want to store our own gold. Let's have it back. So this is fatal, really, for the paper market. And I suspect that the second half of this year, we're going to see this. Now, the problem you mentioned sort of wider quadrillions and all the rest of it. The problem, of course, for the derivatives market is that many of the actors in the bullion markets are also acting in other derivative markets. So if you've got counterparty risk escalating in bullion markets, then you've got counterparty risk escalating everywhere. And this is going to be actually, well, let's put it this way, as the Chinese would say, interesting. The other thing that's interesting in this is we see the gold price rising, up close to all-time highs and so on and so forth. The amount of interest in the West is actually pretty low. And you look at COMEX and you see, as you said earlier on, you've got 440,000 contracts open. I mean, this to me is sort of marginally oversold. I mean, how do you get something marginally oversold at the top of the market?
Yes.
There is another thing. It was reported on Kitco, and I had some Australian friends who were asking me about this. The report that the average portfolio from the sort of people who've got a bit of money, and I think the definition when you delved into it were people who had over $100,000 up to $2 million, that sort of thing. I mean, sort of, if you like, the affluent middle classes. And they reckon that something, I think between 11 and 12% of their portfolio was in gold or gold substitutes of one sort or another. Now, this is not our experience. So I dug into this a bit more. And in fact, it was an HSBC report which covered 12 different jurisdictions, only 4 of which were outside Asia. And the 4 basically were Australia, Canada, the US, and the UK. Now, we know that our exposure, US exposure, portfolio exposure is, square root of nothing virtually. But what it does indicate is the level of interest in Asia in gold. And it's far higher than we think. This bull market, if you like, in Asian terms, has got a long way to go yet. Because, of course, if you look at China, the alternatives are not that attractive. I mean, the banks have reduced their interest rates, so deposit rates there are a waste of time. Property is a busted flush. Stock market is not everybody's flavor. Yet household savings amount to 35% of GDP. I mean, an extraordinary level of savings. This is going into gold. And we're talking about an annual flow of over $2 trillion. So, this is an interesting juncture. And remember also that Chinese, housewife, Mrs. Wong or whoever she is, can't rush out and buy dollars or Swiss francs or whatever verboten. So the only thing she can do is tell her bank, open a gold accumulation plan for me and feed, X thousand yuan into it every month. And that's what's going on, I think. And also India too. That's interesting. And of course, both nations, and this takes us back to silver, both nations do see silver as money, even though we've forgotten that. And central banks don't get involved with it generally. I mean, PBOC is involved with it because they have the monopoly, if you like, of acquiring and disposing of the nation's silver. But other than that, no central bank is involved with it, or they certainly don't make returns showing that they hold silver as part of their reserves. But I can just see these shortages mounting. And as far as the West is concerned, the underexposure in portfolios is really quite shocking. I mean, you would normally expect in a balanced portfolio to see some mining stocks all similar, representing gold, silver, maybe platinum, or things like that, and maybe copper as well. But nobody's been interested for so long. And with respect to gold, I calculated that all over the world, if you look at, I think we've got something like 300 trillion worth of portfolios, how much gold is in them? It's less than 0.5%, partly because gold itself is not a regulated asset. And therefore your compliance officer jumps down in your neck if you try and buy any. But, they're not yet really piling into ETFs, which, of course, the compliance officer has got no problem with. So I think there's an awful long way to go from that point of view before we even start talking about, well, what's driving gold? The answer is that the purchasing power of our currency is going down. They are not there yet. They don't understand it. They really don't. I tell you, I've got an uphill struggle getting people to understand that it's credit going down, not gold going up. We had an announcement, I think it was the sort of, monthly commentary coming out of the ECB about what had happened earlier this year with, the premiums on COMEX and how it sucked in bullion and all the rest of it. And it was quite an interesting article, the way it was written, because it was actually trying not to say too much to upset the markets, if you like. That's the feeling I got. But the one thing they said, the reason that we're worried about this is that Eurozone institutions, their derivatives position in gold have increased 58% compared with the previous quarter, or compared with, previous quarter, or the previous year, whatever. Now, this is interesting because tied with this, they mentioned the stands for delivery. Now, I haven't seen anyone else talk about this. I've been talking about it for some time, and we've talked about it together. But I thought I'd run some numbers on this. I mean, the stands for delivery are very important. I mean, basically, my hypothesis is that when it became possible that Trump was going to introduce flat 25% tariffs on all commodities, all imports, the whole lot, the problem for COMEX, operators in COMEX, is that they had stand for delivery obligations. And these stand for delivery obligations were accelerated. Now, nobody really notices this, but they are absolutely huge. Now, I know that the exchange for physical are even greater, but, we don't know whether that's one way or the other way. I mean, it can be both ways. But, we've got hard evidence with stands for delivery. Interestingly, the Bank of England's vaults lost 14,048,000 ounces between the end of October and the end of April. Yeah. On top of that, the LBMA lost a further 7.7 million for a total of 20,751,000 ounces.
Wow. Yeah, that's big.
The stands for delivery in that time, interestingly, were a bit over 22 million. 22,036,500. Now, you can't necessarily say that these figures are meant to match, but you can see that you've got a problem on one side and you've got a problem on the other side. Now, part of the problem, of course, is that the stands for delivery have increased at a faster rate this year so far than they have in recent years. I mean, I think I'm right in saying that between 2021 and 24, stands for delivery were around about 2,100 tons. This year so far, we're running at the rate of an annualized 1,500 tons. So we're running at close to 4 times the rate, if you like. More, I suppose. Now, the interesting thing, and this is something which I think the ECB is actually worried about, is that all this stuff disappearing from London, how's it going to get back? Because the point about an arbitrage is you do one leg and then you do another leg. Now, what you might do is you might protect your position by, say, taking out an out-of-the-money call option, just in case the price rises too much. But if you've actually, say, taken 20% premium, which at one stage you could do by literally begging, borrowing, or stealing bullion from one centre and selling it into another centre, you've got to get it back because you've got the obligations from where you got it.